There's quite a bit of profit taking actually in the markets, especially the mid-cap space. What was 2:1 in terms of advanced declines is now 1.5:1 in terms of advanced declines, and the mid-cap index has actually become half. Has come to flat terrain, lost all its gains. So you can see a minor narrowing, but I think if you looked at the mid-cap index, you will get an idea of the amount of profit taking. Likewise in the bank index, and to a lesser extent in the Sensex and the Nifty. So interesting time. You will have a lot of ideas coming your way on Chartbusters. But before that, pre-budget, we invite in our special series, What the World Wants from India, a whole host of global experts who look at India very closely and have a view on what they want from the budget. Our guest today is Julian Mayo, the director of Fiera Capital. I spoke to him earlier on emerging markets in general, as well as how he's positioned on India ahead of the budget and the general elections. Listen into that very interesting conversation.
One has to differentiate a little bit between developed and emerging markets. I think the developed market, bull market, if you like, is slightly long in the tooth, and I think is running out of steam. Whereas from the emerging market perspective, the markets obviously had a bad year last year. They had 5 bad years up until 2016, and so actually I think emerging markets are relatively well positioned for 2019, based on really recovering valuations and a gradual recovery in their economies.
All right. So in that case, what's your pecking order in emerging markets on the equity side?
That's a very good question. I think China and India feature very highly in that. So we have our biggest overweights in our global emerging markets portfolios are in China and India for different reasons. As you said, the Chinese economy is slowing down, but nonetheless is continuing to grow at a healthy 6+% growth rate. India is growing at an even faster growth rate of between 7 and 8% on a longer term basis. So those are the two markets really the top of our pecking order.
Okay, well, let me come then straight away to India. Do you get disappointed by the fact that Indian corporate earnings growth has not fired for, 4 or 5 years now?
Yeah, I think that's the biggest concern we have as bottom-up stock pickers in India, is being able to find stocks where there is that growth dynamic and where you are seeing very strong growth. And so I think, for example, the consumer staple sector, which is obviously has been a sort of favourite for investors for a long time, we don't see a huge amount of growth there, and from a bottom line perspective, we've been disappointed by that. But there are areas of the market where growth rate is strong.
Which are those areas?
Well, the financials would be an example. So we see continuous growth in some of the big private banks. So we own, we like HDFC Bank, we own Kotak Mahindra, and Indiabulls Housing Finance, which is a slightly different business, but nonetheless, we think we see growth in the financial sector there, but also in some of the more, if you like, structural stories. Container Corp of India, which is obviously a rapidly growing long-term case as the whole kind of dedicated freight corridor, yes, comes into place and expands over time. And also we have a position in agrochemicals business called UPL, which is obviously participating in the longer-term growth dynamic of agricultural chemicals. That's a low-cost producer, and obviously as the world becomes wealthier, it needs more protein.